So you're thinking about moving to Pittsburgh and you have questions about the whole process and how everything works? Well, today we're going to go through the 10 steps of buying a home. And if you stick around to the end, we're going to share with you the answers to 20 of the most frequently asked questions. If this is your first time to the channel and you want to know everything about living in Pittsburgh, then subscribe below and tap that bell for notifications so you can be the first to know about our current market here in Pittsburgh. I'm Krista Lorenzo with Coldwell Banker, and I get calls and emails every day from people just like you looking for help on making their move to Pittsburgh, and I absolutely love it. Whether you're moving in 1 week or 1 year, give me a call, shoot me a text, or send me an email so I can help you make a smooth move to Pittsburgh. Step 1 is going to be your mortgage pre-approval. And you may be asking, why do I need a pre-approval? It's going to be really important for you to know a range that you feel comfortable with and get a payment that you feel comfortable with. And when you want to put in an offer, we need to have that. So a very common question at this point is, does my credit need pulled, and why do they end up with a different number than when I look it up myself? Michael?
Yeah, so when a lender pulls your credit, a couple things happen. First of all, the credit score that you see with Credit Karma or another company like that always ends up being more like an educational number, something to give you a basic idea, of what your score is. But when a lender pulls it, the algorithm is different because the risk assessment is higher. Right? It's a greater risk when you're buying a house than if you're getting a credit card. So when I pull it, the likelihood is that you're going to be maybe 20 points lower than what you're used to seeing, which is normal, and that's okay. The other reason a lender pulls your credit isn't just for the score. Because of course, your interest rate's a lot of times driven by the score, the program's driven by the score. But at the same time, we want to be able to know how much house you can afford. Can't do that if we can't see your debts and liabilities. So it's really important for a lender to know what other debts do you have so we can help you know your purchasing power.
Absolutely.
Makes sense.
Now, once you have that credit score, does that affect their insurance rates?
That's a great question. Insurance scores can impact your insurance rate. It depends on the carrier. I do have a few carriers that don't take credit into effect at all. But overall, your credit score that is used for determining insurance rates is called a financial responsibility score, and it's not completely based on your FICO. So if you have an 800 credit score, that doesn't mean you're going to have the highest financial rating from an insurance carrier, because insurance is based on all these crazy algorithms, right? And so basically what they look at is, how long have you been insured? If you've had a mortgage in the past, have you paid it? How long have you been with your prior insurance carrier? And they're different between the home and the auto too. So somebody might have a killer insurance score on the home, and then on the auto it's not so good because maybe they let a policy lapse, or maybe they just switched carriers 6 months ago instead of having that 2 years of prior longevity. So your financial responsibility does impact your insurance rates, but not necessarily the exact FICO score.
Okay. So talking about financial responsibility and going down that path, what income are you looking at?
So income can be a little bit tricky. So make sure that you are dealing with a lender, hopefully me, that can help you to calculate that. What's important to note is, are you self-employed? Are you employed by a family member? Are you paid with a salary? Are you paid an hourly rate with a guaranteed set number of hours? All of that stuff comes into effect. So, sometimes if you've just switched jobs, there's certain income we can't count. So being able to really answer and have that to your history, really important.
Okay. So talking about financial responsibility, income, so what does it mean whenever they talk about your debt to income ratio?
Sure. So debt to income ratio is essentially your debts and liabilities versus the gross monthly income that you make. So a lender's always looking at what is it that you're making before taxes are taken out. So a lot of people don't think about that. Be very cautious. What you bring home is obviously less. So if you're eating up a big part of your budget and you're doing 50% of what you bring home, or not bring home, but what you get gross, then that could leave you a little bit tight, right? You don't want to be payment shock, anything like that. So, but we do look at gross income, and lenders try to stay around 45% of your debts and liabilities plus the new mortgage versus what you make.
Okay. So once we have that pre-approval in place, the next step is going to be to set up your search. And this is going to be, what areas do you like? How many bedrooms do you want? Is central air important? Do you need a garage? Do you need a dining room? When I started 23 years ago, everyone wanted a dining room. Now, most people don't care about a dining room, or a dining room is a home office or a playroom or something like that. So whenever we start looking at all of the search criteria, it might get into different areas, different programs that are available. So at this point, it's good to talk to Michael about different programs that are available.
Well, there's a lot of them out there. Don't let that confuse you. You do not need to have all of the knowledge of every program. That's where people like myself come into play, because what we're really looking at is, what's your ideal payment? How much money do you have for your transaction? So there's a lot that goes into that, and what might be a great program for one person might not be for you, because no two borrowers are the same.
Absolutely. So once we have your search criteria set up, then we start seeing houses. So what's really important is to do a drive-by. And people always fight me on this when I say drive-by, and they're like, I can see the pictures, I can look it up on Google. Well, that is not always the true representation of the house. So if you're coming from far away, I absolutely say look at Google Earth. Those are unedited, true photos of a home, not the realtor with their professional photographer or videographer putting the best foot forward. So it's really important to do those drive-bys. See the neighborhood, see if it is a busy road, see if it's at the end of a road, see if it's a dirt road and you thought it was not. So definitely do those drive-bys, and then we get to go inside. So our fourth step is going to be showings and getting to go inside. And before we go inside, sometimes it's really important just to spend a couple minutes and double check those numbers and figure out, which program is best based on that house and how much money you want to put down.
Well, and you know what? Depending on the offer that you want to make, if someone sees a house and they're ready to make that offer, it could vary. The down payment, there's a lot of different options. So one house, maybe the taxes are higher, so a borrower has less to put down for the down payment itself. Maybe we're trying to stay within a certain payment range, so we know that your offer can only be so much of a purchase price. But I'm always, any good lender out there is always happy to run a cost illustration to help you find that out before you start making offers and before you fall too in love with the house.
Absolutely. So as we're talking about down payment, I think gone are the days of when our parents and grandparents were buying houses and putting 20% down. So if people are putting less than 20% down, something called PMI comes into play for them, and a lot of people aren't familiar with what that is.
Yeah, so PMI is private mortgage insurance, and specifically on conventional loans, if you're putting down less than the 20%, then that will be on there, and it's on there until you gain that 20% equity in the property. So what it essentially does is it protects the investor if there's a loan that goes into default. So it's just like any other kind of insurance, right? It's a protection, but it's a protection for the lender, not necessarily the borrower. Different loan programs have different versions of PMI. FHA calls it MIP, a mortgage insurance premium that's partially subsidized. So, down payment, again, calculating that as first-time home buyers, you can do as little as 3% down now, which is really, really helpful. And PMI, what a lot of people don't know too, is on conventional financing, it's very contingent on your credit score. So the higher your score, the lower you pay in PMI.
Okay, great. So once we are comfortable with all those numbers, we get to write up an offer. Now, whenever we put the offer in, this is going to have all the details: price, closing date, contingencies. If you're going to have it contingent on the mortgage, if you're going to have it contingent on investigating insurance, and absolutely having all those contingencies with inspections. The most common ones we see around here are home, pest, radon, and definitely sewer camera. And if you're a little further out or more rural, then you get into septic and well inspection. So then step 6 is going to be negotiations and kind of going back and forth. And we are back into seeing negotiations. Not everything, yay! Yeah, yes, it's a very good thing. Not everything is, the highest and best, and the waiving, hardly anything is anymore. So we are going to go through the negotiation process. And then after that, it's going to be your hand money deposit. So when we had all that craziness, we were seeing, very high hand money amounts. We're back to traditionally like a 1%, hand money deposit, and that is due within 5 days of your offer being accepted traditionally. So once we have our offer accepted, we have that hand money turned in. Step 8 is going to be your mortgage application. So I think it's important to talk about if there are any upfront fees or things like that when you do your mortgage application.
Yeah, so at the time of the application, really the only thing most lenders ask for is the appraisal cost, which typically is in the range of around $500. And if something were to happen, though, where based on inspections, the appraisal didn't happen, then of course a lot of times that money could be refunded as long as the appraisal hasn't already taken place.
Okay. Now, do they have any other things that they have to prepay up front or escrow or numbers they need to start considering at this point?
Sure, well, a lot of those numbers have already gone over.
Okay.
So, closing costs really are made up of 3 different parts. The down payment itself, the closing costs like transfer taxes, things like that, and prepaid items. Prepaid items is exactly what it sounds like. It is literally setting up the escrow account so that your taxes and insurance can be paid when they're due the next year. The escrow account's always running a year in advance. So everything in there now is to pay for next year. So prepaids are really just that, prepaying a part of that.
Okay. So after we get through all that, it's time for your buyer due diligence. This is all your inspections, all your investigations, figuring everything out. So at this point is when we're going to get more into the insurance side of it, because the age of the roof matters, the age of the furnace, all of those things that you're going to find out during those inspections. So why does the age of the roof matter?
It matters because from an insurance perspective, the insurance carrier is protecting the house, right? They're basically making a bet on whether or not this house is going to have a loss and that they're going to have to pay out on it. And old roofs are more likely to be damaged in a windstorm or a hailstorm or things like that. So most insurance carriers, if it's an asphalt shingle roof, they want to see those replaced within the last 20 years. If it's older than 20 years, expect a higher rate on your insurance. Steel roofs, clay tile roofs, slate roofs, you see a lot of those in the South Hills. Those last pretty much forever. Not the steel is going to be like a 30-year. They're going to want to see it replaced in. And on slate, most of them don't want the entire thing to be replaced, but they want some certificate that it has been inspected and that it has been like updated, or if like a slate tile's fallen off, that those are replaced. So those just need to show maintenance.
Okay.
But yeah, so that is one of the biggest rating factors actually on home insurance. Is the age of the roof. Yeah.
Well, I think another thing that might be important would be electrical, just because Pittsburgh is so much older.
Yes.
So does that come into play?
It sure does. So in all honesty, as long as it's not knob and tube wiring. So I do have some carriers that will accept knob and tube on like different scenarios, like if it's only at 10% or less of the house is knob and tube, or a lot of my carriers, people buy an older house and they're planning on replacing the electrical within 30 days. They'll accept that risk with the client's word that they're going to be replacing it within the first 30 days. But yeah, if you go and see a house with knob and tube wiring, that might be a really great opportunity for negotiation.
Absolutely.
We talked about.
Yes, absolutely, for sure. So at this point, it's about where we start to have the appraisal happen for the mortgage contingency. So do you want to tell us a little bit about the appraisal?
Sure. So the appraisal process is really a third-party person, the appraiser, going out and letting a lender know based on their assessment what the property's worth in the market. Is it worth what the borrower is paying for it based on the comparables that are out there? So they want to compare it to things that are like that house, things that have sold recently, maybe the past 6 months or less, things within a mile range. They're not really going to compare it to things that closed a year ago and are 3 miles away.
Right.
So we really want to gauge that what we're lending for that purchase price and for that loan is legitimate for what the house is worth in today's market. The appraiser also, kind of like with the homeowner's insurance, they're going to let us know if there's any major health or safety issues. Is there an obvious leak in the roof that they can see because it's dripping on the inside of the house? Is knob and tube exposed? Because that could be a problem. for lending purposes, knob and tube itself isn't necessarily a bad thing, but if it's exposed, then it's a problem.
Right.
Is there mold, things of that nature?
Okay. So we have the appraised amount, and does that affect whenever you're computing like the replacement cost and purchase, and how does all that work?
Such a great question. No, it doesn't. So from an insurance perspective, the insurer is looking to cover the structure of the home and any other structures that are on the land. They don't cover the land, and they don't cover the market value, right? They're just looking, how much does it cost if this house were to burn down to the ground? How much is it going to cost us to rebuild it at the same like, kind, and quality that it is today?
Okay.
And so this is where sometimes it can be a little bit tricky, because if the house is in like, what's a high value area, like FAQS Chapel,
Yeah.
or something like that, the market value might be much more than that same house would be if it was in Newcastle. And so sometimes with lending, it can get to like, well, the loan is this amount and the homeowner's insurance needs to show that it's covering this amount. And it's hard to sometimes help people understand that from an insurance perspective, we're not looking at the loan amount. We're looking at, can we rebuild this house at the same like kind and quality that it is today? And sometimes it's the alternative, right? Sometimes the insurance is, the replacement cost comes in higher because it is in a lower cost area. And people are asking me like, damn, you like way over insured this house. It's not worth that. I'm like, well, it might not be worth it on the market, but that's how much it's going to cost to rebuild it. And right now, with the cost of materials, the cost of labor, replacement costs are being inflated with inflation. So it's not like an inflated amount, but it's correct.
Right.
And so we're getting a lot of increases and things like that based on that cost. So yeah, from an insurance perspective, just know they're looking at the cost to rebuild that house at the same like kind and quality that it is today. They don't take into consideration the market value, and they don't take into consideration the land value.
Okay.
Oh, interesting.
Yeah.
And another thing that people ask a lot with insurance is I have a lot of first-time home buyers that want to get a puppy. There's puppies, there's pools, there's trampolines. Do all of these affect their rate as well?
They generally, well, some carriers are charging for dogs now, which I like because it's better than saying, no, I don't want this risk because they have a pit bull. Now they're just saying, do they have a dog? Is the dog over 25 pounds? If so, it's $75 more a year for their insurance. And the reason for that insurers care about trampoline, swimming pools, and dogs is because liability insurance extends off your homeowner's insurance. So if somebody gets hurt on your property and sues you, that is going to be paid out by your homeowner's insurance.
Okay.
And so if you have a trampoline, accidents happen, right? Your kids' friends come over, jump, somebody falls off and breaks their arm.
Ankle,
We're gonna go with
Yeah.
If those parents decide to sue you, which sometimes is not even their choice, sometimes the hospitals urge them to sue you, that's going to come off your homeowner's insurance. Same with the swimming pool and dogs. Unfortunately, they jump on people if they bite somebody or something like that. I had actually an instance where the pizza delivery guy came and a dog jumped like at their car and scratched the side of their car.
Oh, wow.
Homeowners insurance pays out on that because it's liability and that follows you wherever you go. So anyway, that's why they ask.
Okay.
But I will say carriers have gotten a lot better about accepting those things. They just want to know, is the trampoline netted? Does the pool have a fence around it?
Okay.
Is there a diving board or a slide? Because those increase the odds of somebody getting hurt.
Right.
And then on your dog breeds,
As a parent, we know that.
Right.
Exactly. Even as like a person who was a child at once, we know that. Or like anybody with a husband.
Right.
But
all these people.
Exactly. And then a lot of carriers do still have dog lists. So if you just know if you're getting I have a German Shepherd Husky and she is on dog lists.
Okay.
If you're getting a Pit Bull, a Rottweiler, any dog that has a really strong jaw, chances are they will be on a dog on a list. But if you're working with an independent broker, they'll have multiple options and you won't have a problem finding a company.
Okay. And is that something they have to pay for before closing, their insurance?
That's a great question too. It really depends on how the loan is set up. Michael had talked earlier about the escrow account. If they're going to have that, then generally it is paid at closing as part of the closing costs.
Okay.
And then it just goes into that escrow account. So we just set it up, and then I would work with Michael or whoever your lender is to get the mortgagee clause, the loan number, and everything like that. And then from our perspective, we take care of all of that for our clients. I
Okay.
don't know how other insurance agents do it, but generally the homeowner's insurance, there's no out of pocket upfront for that premium unless there is not going to be an escrow.
Okay.
Or if it's flood insurance, a lot of times that's required to be paid upfront by the client. So make sure you know if you need that. And
We will know by this point. Yeah.
exactly.
Yeah,
Yeah.
yeah.
So there are times where it needs to be paid by the client, but I would say out of the homeowners policies that I do for home buyers, 90% of them are paid at closing. So the client
Okay.
doesn't pay me anything up front.
And would this be a good time for them to check into bundling to see if they could save in
Yes.
other areas?
Absolutely.
Okay.
Yes, because so the big discount on the bundle is on the home side.
Okay.
So you get usually between all my carriers between a 20 and 30% discount on the home if we have the auto, and then the auto is usually like a 5% discount, so it's not quite as big.
Yeah.
But auto premium is generally higher than home premium, so it can be a decent amount. But definitely, if it's your first time getting a home owner's insurance policy, let that agent quote your auto.
Okay.
Chances are they're going to save you money on both, and you're going to be in a better overall situation. And then also that agent has the view of everything, so that when it comes time to like maybe make a change or do a reshop or something like that, they're able to see the full package and make
Okay.
sure that you are served the best way possible.
And that's a great way to save money since some of the inflation costs and cost of insurance and interest rates have gone up. Then by bundling, that's one way you can really save.
Yes.
So once we have all of that in place, it's basically just time for our final walkthrough and closing. So final walkthrough typically happens just before the closing. We want to make sure that the house is still in the same condition as we saw it. We want to make sure that any repairs that they said they were going to do, they took care of, and that everything looks the way we expect it to look. And then we get to go to closing. Woohoo! So closing typically takes about an hour. It is usually attended by the buyer side and the seller side unless they've already moved out of state or can't come or illness or anything like that. And then it's just handled, kind of separately. At closing, you're always going to want to make sure you have 2 forms of photo ID if you are the buyer. Seller needs to have 1 form of photo ID. And I always say that for that second form of photo ID, to bring your personal checkbook. And I know some of you people don't have personal checks, but it is good if you can go to your bank and just get one. Sometimes those closing figures change just by a couple numbers, and it's great just to have that there in case anything is different. So then we wrap up the closing. You are handed that set of keys, and that property is yours. We will celebrate with a photo, sometimes a little dance, and you are now the proud homeowner of your new home. Woohoo! Congratulations! And like I said, whether you're moving in 1 week or 1 year, give me a call, shoot me a text, or send me an email so I can help you make a smooth move to Pittsburgh. Until next time, I hope to show you around town.